Hey everyone, I've just decided to come to a nice quiet place by the river to reflect on last week's avalanche of emails, texts, videos, social media, everything from our aggregators to clients asking questions and just what's happening. I came to realise over the weekend that really the general public and even people who have borrowed in the past don't really understand what mortgage brokers do. So rather than focus on what everyone's going on about with the Royal Commission recommendations, I actually want to go through what a broker does that is important, and that if these things are passed by legislation, will not be available or will be limited availability to some clients looking to borrow money or sell or refinance their loans. So the biggest thing that came out of it is brokers possibly losing their trail, and also commissions that are normally paid by the bank may get passed on to you guys, the consumers. So there's a whole lot of arguments around this, but to be honest, I just really don't want to reflect on how a broker is paid. I want to reflect on who pays the broker. So currently the banks pay us. Most brokers are free to access. We do as much as we can to get your loan to a bank that is going to be suitable for you, and usually it's happy days after that. So I just want to give you a couple of scenarios that may affect you. So what I've done is I have printed out, and you're not going to be able to read this, but I'm just going to tell you about it and show you where I can. When you seek a mortgage broker's advice, we take all of your things into account. So we take your income, your dependents, your living expenses, all that sort of thing. And then we assess it, and we look at what each bank would lend you based on your particular scenario. Now the reason this is important is because banks have different policies. They use different figures in the background. They have a different assessment rate. So, oh shit, just went in the water, sorry. I'm sorry I can't show you now, but I can explain it to you. Sorry, it's in the drink. That wasn't planned, promise. Okay, carry on. So, where was I? So what I did on this piece of paper that you now can't see is I took an average client. So I had Mr. and Mrs. Borrower. They had 2 dependents. They had a decent income of about 80,000. Hubby worked and got overtime. Mum received a bit of a family allowance. They had a car loan, and they had an average credit card of say 5,000. So what I did is I looked at all the banks to see what they would lend. Now I can tell you, and trust me, even though I can't show you now, because I don't know if you can see my piece of paper in the water. So the difference was 63,000 between one bank's assessment and another bank's assessment. So 63,000 is a lot of money for some people, a big difference to whether you're going to be able to borrow for your home or not. The reason for this, there's 4 components that affect this. So some banks don't take overtime or don't take 100% of overtime income. Some will only take 80%, some will take 50%. Totally depends on the circumstances. The other thing that the banks use is an assessment rate. So some banks will use 7% to assess your loan instead of what the current actual rate is. And there are some banks out there who are actually using as high as 7.6. Now this difference makes a huge difference to the assessment again as to what they would borrow, what they will lend you. So for those banks that are only going to lend you the lower amount, they've probably got a higher assessment rate. So then the other thing that they take into account is living expenses. So you tell us your living expenses, you tell us what you spend your money on, whether you go to McDonald's, what you do. We have a look at it all, and we put that figure in that you declare. Now the banks have their own figures that they use. Some will use the HEM, which is the national average. Some will use the HEM plus a bit more. Some will use what you have disclosed to us. And again, this can make a big difference to the amount that you can borrow. So there's a couple of examples of the different things that the banks use to assess how much they're going to lend you. This is all totally based on information that you give us. There's so much more. There's where you got your savings from, there's how long you've been in your job, there's how many times have you moved, there's your credit history. So all of these things a broker can put together like a huge puzzle and come up with a picture of the banks that are going to assist you. So the reason I've told you all of this is because if the legislation is passed and you guys now have to pay brokers, well, rather not now, but in 18 months if it passes legislation, 18 months to 3 years, sorry, that means that you won't want to pay a broker. Now we could get paid, you know, let's say $3,000, $2,500, $3,000 for an average loan. That means that you guys are going to have to pay that to us up front for your deal with no refunds, because that's our income. We'll have no trail. That will be how we get paid. Just like financial advisors, accountants, lawyers, solicitors, all of them. But the difference for us is that you can go straight to the bank. Happy days. Well, not so much happy days, because I actually have a client right now who went to their own bank, have been with them forever since he was a kid, massive savings, perfect conduct, just your average person, but the bank is making it so hard for him to get an approval because of other things going on in the background that he has just decided he is leaving that bank. And as a broker, I have now taken him to another bank where his application is straightforward. Same circumstances, same details, just the bank's using different things in the background to assess his application. And this is what I want to get across to you guys, that you may go to a bank, get declined, you may go to another bank, get declined, and then you may go to another bank and get approved if you're lucky. But all that time to do this, the inquiries on your credit history can all impact you. Whereas a mortgage broker can just look at all this stuff. We don't even approach a bank or ask you which bank you want to go to until we've done all of our research and said, given you at least 3 options and said, look, these are the banks that are going to accept your application. Pick one and we'll do it for you. So that's where our worth is, and yes, we are worth it. So we are lobbying to stop the banks taking our trail. We are lobbying to stop the banks making you guys pay, because in the end, if everyone just decides to go to the bank, bank's going to get market share, interest rates are going to go up, and even though they're calling it responsible lending, you guys are the ones that are going to end up paying not only upfront fees, but higher interest. So I hope that's helped you explain. I'm so sorry I don't have my piece of paper. I don't know if you can see it floating down the, oh, there it is. You can see it floating down the river. I may do another video actually where I can point it all out to you properly. But if you've got questions, let me know. It's not going to stop here. You're going to hear a lot about it. So I hope this video has helped you understand exactly what we do and why it's important for us to keep our livelihoods, and why it's important for you guys to have access to us without paying. Okay, happy days, have a great day. Please, please, please call me if you've got questions, and I'd love you to share this video for me, just so the Australian public knows what's coming. Awesome, thank you.